And we're up. Tonight we're going to be talking about mainly two areas. We're going to review financial statement analysis by looking at one more situation involving financial statement ratios and analysis. Then we're going to talk about the definition of cost of capital. One of the key ingredients of determining the return of assets that you're managing is, are they going to be returning enough cash flow and profit to substantiate the cost of that capital to initiate the purchase of those assets? And that's a key ingredient. You began the look at that in your question number 4 in your case of last week that you've posted this week, determining the cost of equity. We're going to take a look at that a little bit more detail this evening with some examples and some analysis. I gave you a taste of that in the introduction video to our class, where the definition or the difference between what is debt in the market, what is the cost of debt, what is debt as far as CFOs are concerned, and that was an introduction into our discussion this evening. Before I get to that, though, I'd like to just go over a couple of points, even though the grades for case number 1 will not be posted until tomorrow. I wanted to go over a couple of things tonight while I have you in class to go over a couple of those problems that will lead to future discussions and problems.
Wait, hold on.
Will lead to other future future study and problems. And the first two questions of the case ask you to determine the present value of a series of cash flows going out into the future, and also determine the payment of a debt in an amortized loan. And these solutions have already been posted to Blackboard, and you can look at them in conjunction with your casework when I return it to you tomorrow. But it leads us to some of our discussions tonight. In the case of part 1, we are given a series of investment returns for a particular asset or an investment. $12,000, $14,000, $17,000, $19,000. $23,000 and $29,000 as return off an investment in an asset. Well, our job on this problem was to determine what is the present value of those funds being received in the future with a discount rate of 11%. And the discount rate is the subject of our discussion this evening. What is the cost of money to take that future value of return and bring it back to today's dollars? In other words, this investment in part 1 is returning these dollars into the future, but it's costing us 11% to purchase the asset that enabled us to return those dollars. Well, if you take a total of all these returns of money into over the 6 years, that's $114,000. But the discount amount, or the present value amount, is $76,274 rounded. In other words, the $114,000 discounted back at the cost of 11%, that's the true value in today's dollars. And we would compare that value, today's value, based on the flow of income being received in the future, discounted at the cost of capital, in this case 11%, to the actual investment in dollars we made. And hopefully this present value is greater or much greater than that investment in that financial resource, the asset. That's one of the key points of capital financing and CFOs, is when they make a decision to invest in an asset today, and that asset is going to be estimated to be paid off in return over a course of 6 years, is that going to warrant enough return? And that's the complex of this analysis, is how do you determine what these cash flows are, chapter 10 and 11, and how you determine the 11%, chapter 9. That's the calculations used to determine that investment return. So that's an important facet of our study, is to be able to understand that and calculate that. And that's what I was asking for you to do there. That is a discounted cash flow analysis of a future cash flow into the future, discounted at appropriate interest rate, given in this problem as 11%. The second calculation, is part 2, was to determine the present value of payments on a loan of $22,102. That loan is originally to buy a car at $25,700, but you're making a down payment, so the actual loan is $22,102. The car is going to be financed on a monthly basis over 5 periods or 5 years. That would mean 60 payments. And the interest rate on that is quoted as an annual rate of 8%. Well, the annual rate, I quoted at an annual rate, but on a monthly per payment level, that's the interest rate per month. We use those 2 items, the number of payments, the interest rate per period, and naturally the amount we're financing, to determine a monthly payment of $448.15. In other words, if we make 60 payments of $448.15, we are going to pay off the $22,000 loan plus the additional interest, which is annually at 8%. That's the present value of the cost of debt over time. $448 every month for 60 months. That's an important number. We run into these monthly payment things all the time in amortized loans. One of the things we talked about last week is the difference between a bond financing and this type of financing, an amortized loan. A bond is an unamortized financing, interest only until maturity. Whereas here, this unamortized loan, you're paying principal and interest over time. And the reason for that is all based on your credit history. You're able to generate collateral to finance or back up that loan. So 2 important calculations to determine the present value of a series of payments off an investment and the loan payment on a loan over a period of time, called an amortized loan. Again, these will be posted, it's already posted to your Blackboard, and you can review them, and I will post you my my case return to you tomorrow to your grade centers. One last thing I want to talk about in this case number 1, whereas questions 1 and 2 are doing actual physical calculations, question 2 is looking at some writing about defining bonds, how the interest rates or corporate bond ratings are determined, and why do some bonds sell less for their face value, why others sell at a premium. I'm looking for your interpretation of those questions. And then in question 3, I'm looking for your interpretation of a stock analyst of General Electric. And you can interpret this many ways, and you'll see that in my interpretation. But I want to see your interpretation of how you would generate as an investor, give examples to how that investment has fared over this period of time. But the next area I want to look at is question 4, because that leads us into our discussion this evening, and especially into case number, especially to the discussion forum post of this week that you have to do. This week we have a discussion post on WACC, weighted average cost of capital, which many of you have heard before. But this work tonight is going to be taking a look at the actual WACC return of a real corporation. Naturally, I'm going to give you some figures to use in your calculations, but that risk, that beta of that corporation is going to be a driving factor in determining its cost of capital. Remember, the cost of capital in the question number 1, part 1 of the case number 1 was 11%. That's our cost of capital. Well, in question number 4, I ask you to take a Dow Jones company and determine the cost of equity of that problem. And here that answer is here. Now, it's going to be different for everybody because you all had different companies, different risk, But the things that hold true in this problem are the risk-free interest rate of 0.7%, the market risk return of 8%. And then from that information, I was asking you to determine the capital asset pricing model required return on equity investment. And another interpretation of that is it's the cost of equity. It's part of the information we use to determine the weighted average cost of capital. We determine the weighted average cost of capital by the cost of equity and the cost of debt. So in this example, I took Johnson & Johnson. All right, they had a credit rating of A, big A, little 2, double A. Their beta, or their risk calculation for the prior 4 quarters or 4 years, was 0.71. The capital asset pricing model says if I want to determine in today's market, today's risk, what was going to be the return on equity investment for an investor of this company, the capital asset pricing model tells me to take the risk-free rate and add it to the market premium times the risk-free rate. In this case, the definition of market premium is the market return, 8%, minus the risk-free rate. That's the market premium. It's the difference between market return and risk-free rate. So we get 7.3% as the market premium. So then to complete the capital asset pricing calculation, I take the risk-free rate plus 7.3% times the beta of the company, the risk of Johnson & Johnson in the market of 0.71. I get 0.7% plus 5.18%. That's the risk times the market premium. And I get a capital asset pricing of return on investment of 5.88%. So based on the risk of Johnson & Johnson in today's market, their beta is calculated at 0.71. If I were to buy stock in Johnson & Johnson at this time of year, at this day, I would expect a return on equity of 5.88%. That's based on what I can get in the risk-free market, 0.7%, not very good, or in the average return market, which is a beta of 1, 8%. So since the risk of Johnson & Johnson is a little bit less than the market return of beta of 1, that means I'm going to generate less of a return for my investors because it's less of a risk, not as risky. So I'm only going to get a return of 5.88. Now, am I going to get that return? Depends on the market. Depends on the performance of the company over the next period of time. But the CFO of Johnson & Johnson now knows in the market with Johnson & Johnson's risk fairly low, at the risk of in the market risk of risk-free and average, their cost of money in the equity market is pretty well calculated at almost 6%. It gives an idea that Johnson & Johnson in the market has pretty good credit, has pretty good risk based on past performance. Does that mean what's going to be their performance in the future? No. But it gives us to put a stake in the ground to determine its position, its credit worthiness today. And we're going to use this calculation in all our problems going forward to determine the cost of equity for companies and also to determine the cost of debt in relative to the market, and combine those two to determine the overall average cost of debt based on the capital structure of the company, how the company is currently financed, the mix of debt and equity. So you're going to take this information, in my case, 5.88%, and that's going to lead into the discussion post for this coming week that you'll have to do. And we'll talk more about that later. So these are the discussions, or these are the results that lead us into more discussions, more calculations about determining the risk and return in the market of a specific investment and the risk and return of our company in the overall market viewpoint as highlighted here by the capital asset pricing model. So we need to remember these key points, and a lot of you have studied these before, but these are key points that we're going to carry forward throughout the rest of our strategic decisions in our class. So for Johnson & Johnson, their money is fairly cheap now, both in debt and equity. That's a good thing. But at the same time, it also gives them a picture of, do they need to get better compared to their competitors, compared to the industry? And that's what we'll talk about a little bit later on this evening. So that's the highlights of quiz number 1. Again, the solutions are already in your Blackboard, and you can review those, especially when I post your individual works tomorrow to your Grade Center. Okay. Now, I want to go back to what we discussed last week. I want to bring up a file folder that's already included in your Blackboard, and you can download it if you want. If not, you can take a look at it later. One of the difficulties of taking a class online is if you want to work on your computer while Professor Hassey is yakking away, it's a little bit different unless you have multiple screens or can splice up your monitor to do both. But I want you to refer to week number 4 now in an in-class review spreadsheet. And I'm going to be using this and updating it and posting it after class as well. But I'm going to be using this week 4 in-class review worksheet right now. A couple other things to point out. After we do some work in this worksheet, I'm going to have a lecture on WACC, refresh our memories, and the capital structure. It's going to be based on this PowerPoint presentation, just so you note that for the future. Here are the PowerPoints of the chapters, and also you can look at a video. And this is for review later on. But let's take a look at this spreadsheet, week 4 in-class review. Hey, it's blank. I'm looking at chapter 13, problem 3-13. Now, if you don't have a textbook, don't worry about it. I'm going to be putting the numbers in here at the same time. But we're taking a look at a financial statement of a company called Lozano Chip Company. This is problem 3-13 at the end of chapter 3. And this goes back to the ratio analysis. And we talked quite a bit about this last week, but I want to do one more because here's why. This week we have a discussion post and you're doing some weighted average cost of capital analysis in relationship to the actual company you selected from quiz number 1. Next week we have case number 2. Case number 2 will be a financial analysis of a real world company. You'll be doing an analysis of a financials of a company, and you'll be finding these figures, these ratios, these analytical numbers, and also interpreting and writing about them and doing a financial analysis of that company. That financial analysis will require you to calculate the information, but at the same time, interpret it and what does it tell you. In chapter number 3, they give the definitions of all these. In the PowerPoint I give you, they give the definition of these. But also you need to know how to calculate them and what they mean. And we're going to go over this exercise now to practice a couple of the key variables that you need to be familiar with for case number 2, beginning the week after next week. So the first one is called the current ratio. We've talked about this before. The current ratio is in some quarters called a liquidity ratio. It's a determination of the relationship of working capital, operating working capital, short-term current assets, short-term current liabilities. That's called operating working capital. Do you have enough cash, receivables for collection, inventory to sell, versus the amount of payables and accruals that you have due and or notes payable due in the current year. What are your obligations in the current year, and what assets do you have to turn those assets into cash to pay those liabilities, those obligations in the next year? It's called the current ratio. It's kind of a quick and dirty way of saying, oh, okay, I'm fairly liquid to cover my obligations over the next year. The definition of it is current assets divided by current liabilities. Pretty simple. And in this calculation in problem 313, the current assets total $2,925,000, and they'll be divided by the current liabilities of the company, $1,225,000. That current ratio comes out to 2.39 times. In other words, the current assets are 2.39 times greater than the current liabilities. Oops, I left out a zero, excuse me. Now, it just so happens that the industry average for this company, comparable to their competitors in the industry, is 2.0 times. So their current ratio is a little bit higher. Is that a good thing? No, it's not a good thing, because it probably means they either have too much cash, and that some of that cash should be invested longer term, getting it out of current and invest it, or they have a combination of too much current or too much accounts receivable or too much inventory. Too much accounts receivable, meaning they have a collection problem, and we'll see that in just a minute. And inventory means maybe they have too high of inventory. That's making them illiquid in a current basis. So you want to have a fairly, in the real world, current ratio should be anywhere from 1.25 to about 2. This current ratio is a little high. And if they have too much cash, they should be investing that out. Why are they keeping cash short term when they have enough receivables and inventory and cash to cover their obligations? One of the key positions in the financial operations of a corporation is treasury management, management of cash flow. And yes, it's always great to have enough cash to pay the bills, but sometimes it's a mistake and a problem to have too much cash. You should invest it. You should get out of there. Get it out of there. Make it earn some income. And that's one of the objectives of the current ratio, is to tell you about liquidity and its relationship to your obligations. Another indicator of management efficiency is called days sales outstanding. And this is a ratio or an analysis to determine efficiency. Efficiency. Are you collecting your receivables? Question. Are there industries where you have to keep high liquidity? I can't think of any, to be perfectly honest with you, Efren. No, I think you have too high equity or too high liquidity. That's telling about poor management. Poor management. Now, it might change on a quarter-to-quarter basis, but usually you should keep that pretty thin. It's just like when I was managing a company, I always got very upset at my office manager, my business manager, when we had too much cash sitting in the checking account. Why? I know what our payables are going to be, due this month. I know what our payroll is. I know all our bills. Why am I carrying so much cash? That we're losing money. We should put some of that invested out into a money market fund or a CD or something. Earn some income off of that. Why have it staying just earning no income in a checking account? That's a good example of that. Thank you, Efren. Day sales outstanding is the relationship of accounts receivable divided by your total sales divided by 365 days in a year. In other words, if this company has an accounts receivable balance of 1,575,000, their total sales in the current year are $7.5 million. And I divide that by 365 days to determine their average sales per day. Their average sales per day. In other words, I take their current receivable balance divided by how much they're selling a day, and I get a number that's kind of ugly. 76.65 days. It's taking them over 76 days on average to collect their money. Now, if any of you are working in companies or working in accounts receivable or working in treasury operations of a business, that ain't good, because a lot of your payables and your payments are due on a 30-day basis, and it's taking you 76 days to collect the money based on this calculation. The industry average for this business is 35 days. They have a problem with receivables. Either they're not collecting them per procedures within their accounts receivable collection agency, or they're doing business with a bunch of deadbeats, which sometimes happens. Many times we sell to customers and they become very loyal customers. But sometimes loyal customers can take advantage of that and tell the salesperson or the sales organization, hey, you know, I can't make the payment this month. Can you give me a few extra days? And then also I need to place another order. Sure, you've been with us for 10 years, no problem. Ouch. That's why if any of you are in sales or marketing, that's why many times salespeople are paid on a commission basis. Not on only what they sell, but what is collected from those sales. So if the salesperson is selling those products, good. But at the same time, they got to make sure that they're paying the bill and collecting. Then they'll get their commission. And that's the constant battle between finance and marketing, is making sure we're selling properly, but are we also collecting the money? So days sales outstanding is another important efficiency judge of a company. Are they collecting their money? That all goes back into current assets and current liabilities, the current ratio. Here's another one along those same lines of sales, but on the other side of the coin. All right. Inventory turnover. Another efficiency measurement. How fast are we turning over inventory? You know, one of the reasons you can go to Target and Walmart and Costco to buy things is because they're cheap, discounted, cheap, buy in volume, bulk, it's cheap. The margins between cost and selling price for those items are very thin. How does Costco, Target, and Walmart make any money off those thin margins? They sell them over and over and over again. They turn over their inventory rapidly. If any of you are working for a company that has inventory, one of the key things of inventory supply side management is to make sure you turn over the inventory. Even though you're making not very much profit off that inventory item, if you sell it more and more, that profit can grow because the quantity is going there. That's why Costco, Sam's Club, and all those firms do so well. They sell in volume. It's cheap and in volume. They're not making much profit per unit, but if you buy a whole slab of toilet paper, they're making a lot of money because you're buying volume. So inventory turnover is an important figure, and what it is, it's the cost of goods sold of a company from the income statement, the cost of goods sold divided by the inventory of the company. So in the case of this problem, our cost of goods sold for the current year was $6,375,000. That's taken right off the income statement. And I divide that by my inventory balance at the end of the year, $1,125,000. So how many times has this inventory turned over in relation to how much inventory we purchased during the year? 5.67 times. We've turned over the inventory almost 6 times. Selling it, restocking, selling it, restocking. The industry average for this company is 6.7 times, not as high. The higher this number, the better. That means you're purchasing inventory or producing inventory, and then you're selling it quickly over and over again. Inventory turnover. A very important number for people who are managing inventory or distribution centers. Very important. The next one is what you guys probably know in your sleep. It's called the profit margin. And this is a determination of profitability of the company, the profit margin. The profit margin is simply the net income for the current period divided by the total sales of the current period. And for this company here, the net income was $114,000 for the period of time, and their total sales, as we saw before, was $7.5 million. The profit margin is a percent number, and in this case, the profit margin of this company is 1.52%. The industry average, 1.2%. So they're doing pretty good there. Remember, again, the higher this, the better. So for every dollar of sales, we're making 1.5 cents. That's our profit margin. Okay, our profit margin. Revenues minus expenses to produce those 7.5, excuse me, those $7.5 million of sales, we're making 1.52%. Return profit margin. A good number to know because that tells you your profitability spread, how you're doing. Naturally, the higher that is, it's great. But for a lot of companies like Walmart and Costco, what we were just talking about, those profit margins are not on a per unit basis. They're very slim. You want to make your profits off turning them over a lot and building up those profits. Whereas corporations like General Electric or Boeing, who produce jet aircraft, diesel engines, trains, nuclear fusion, you're only going to sell maybe 10, 15, 20 of those a year. So your profit margin on those units are going to be quite high, 15, 20, 25%. Why? Because you don't sell many of them during a year. Not too many people buy a lot of jet aircraft, especially these days. Not too many people buy nuclear fusion factories or plants. Doesn't happen much. So you got to make big profit on that because there's less turnover of inventory. With retail and smaller margins, you make your profit by turning it over a lot. We're going to be looking at companies next week that some are manufacturing, some are retail, some are financial institutions. How does that mean when you take a look at these numbers in relationship to their industry? Another profitability ratio is the relationship of, it's called return on assets. That's another profitability relationship or number. And what it is, it's net income divided by your total assets. Return on assets. What percent your profit is of the asset base of your company that's generating that income. And for this company here, again, the net income was $114,000, and the total assets of this company are $4,275,000. Thus, a return on assets of 2.67%. The industry average, 3.6%. In other words, the assets are generating a return of about 2.5%. The profits generated by the investment in those assets are generating about 2.7%, let's say. Return on assets. Nice spelling, Mr. Hassey. Sorry. There we go. And then we take a look at one of the most important figures that we'll be looking at. The next two is debt ratio. And this is a determination of the company's leverage. The debt ratio, the relationship of total debt of the company, both short-term and long-term, to the total assets of a company. What percent is debt to assets? In other words, what percent is debt in the capital structure? Remember that phrase. What percent is debt in the capital structure of this company? All right. Well, total debt in this case is I'm taking all the debt of the company, both short-term, long-term, that is in existence. And I get the total debt of this case is, hang on, $500,000. Excuse me, not 500,000. My current debt was larger than that. Excuse me, I'm misreading it. $1,725,000. And I'm dividing that by the assets of the company, $4,275,000. All right, I get the relationship of debt to assets. That's important. Remember the accounting equation. Assets equals liabilities plus equity. The capital structure of a company is the combination of debt and equity to fund the asset base. So if I put that together in an equation, equals $1,725,000 divided by $4,275,000. I get roughly, and make that a percentage, go to two decimals, 40.35%. The industry average for this industry is 55%. So that's my debt ratio. Now here's a question I pose to all of you. You don't have to answer this, but you probably do it in your head very quickly. If my debt position is 40.35% of assets, what must be my equity percentage position? $59.65%. The difference between 100 and 40.35. My equity position must be 59.65%. That totals to 100%. Asset liabilities plus equity equal assets. This is called the capital structure. We need to know the capital structure to determine our weighted average cost of capital. It's an important number. So debt as a percent of assets. Whatever the difference between that and 100% is, must be the relationship of equity to assets. This company is fairly debt-free in relationship to the industry. Now, the last ratio in regards to this type of capital structure leverage is called debt to equity ratio. debt to equity rate. What is the relationship of debt to equity? All right. So if our debt is 1,725,000 and our equity position has got to be the difference between 4,275,000 and 1,725,000. So let's calculate that over here just briefly. $2,550,000. Again, if my assets total 4,275,000 and my debt is 1,725,000, my equity position has got to be the difference, or $2,550,000. What is that relationship? What is the relationship of debt to equity? Let's do it. 1,725,000 divided by 2,550,000. And debt is basically a third of equity. There's no industry average for that one. I threw this one in. So what does that mean? It means that debt is about 2/3 of equity. That is about 2/3 of equity. Now, does this tell us anything into the capital structure? No, not really. If we're given these numbers, we can determine capital structure by using this information. But I'll save that for another day and another task. But just tells us of the relationship of debt to equity on the right-hand side of balance sheet. When you see a high debt to equity ratio, it means the company has less debt. Less debt, meaning the equity position is kind of high. So that's what we want to show. So going back through this, and I'll post this back to Blackboard after class, but these are some analysis that you will be doing in case number 3 and their definitions. And their definitions are also in chapter 3. But these are things I want you to be aware of in looking at the performance of the company in regards to liquidity, efficiency, profitability, and leverage. And those are key points that we're going to be doing in all the rest of our cases going forward, knowing those relationships. Okay, so I'm going to save that. Pretty straightforward, nothing too fancy. But we will be looking at these next week in case number 2 and further on in our strategic cases as we go forward. And I want to say, I know some of you, I know you're not thinking this, or maybe thought it while you're doing case 1, but case 1 really wasn't a real case. It was just a series of questions leading to the theme of the case. Being able to analyze cash flows, being able to analyze debt, capital valuation. It's kind of the theme. Whereas beginning in case number 2, the case will be one singular problem where you're asked to solve it and asked to interpret the information and however I see fit in describing that data. So case number 1 was kind of a practice, getting used to the basics. And when we go forward into the rest of our cases in this class, they're more concentrating on one particular idea or theme. Okay. All right. Now let's do this. And then we'll take a break. Oh, I have a chat. Do I have a chat? Sure, Peter. Peter asked for an explanation of capital structure again. Capital structure is defined as the mix of debt and equity for a company. In other words, I have assets. They are funded by debt and equity. What % of those assets are funded by debt? And what percent of those assets are financed by equity. That's the capital structure. So if I would ask you the capital structure of this company based on what we did over here, the capital structure is 40.35% debt, 59.65% equity. One of the things we'll study later on in the course is companies manipulate the capital structure of their company over time to find the cheapest money, the cheapest capital. What percent of debt or an equity to finance your assets provides for the cheapest capital? If you find the cheapest capital in those mixes of percentages, the value of the company will be at its highest value, highest wealth. And we'll talk more about that later on, but the capital structure leads us into those discussions. It's the combination of debt and equity that funds assets for a company, balance sheet, the capital structure. Okay, Peter? Okay. Well, now that we've done some financial numbers, well, let's take a look at the theme and the definitions of Chapter 9. Weighted average cost of capital, and as I just said, company valuation. The cost of your money is going to determine the value of your company. The cheaper the money, the greater the value. And we'll talk more about that in just a few minutes. The required rate of return of a firm's projects can be calculated using the weighted average cost of capital, WACC. And I'm sure you guys have heard this before. We're going to practice this in discussion post number 3 this week. The weighted average cost of capital is the after-tax return the company needs to earn in order to satisfy all its security holders. Another name for that is their investors. Remember back at the beginning of class, I talked about the investment principles. The investment principles, or the principles of capital or finance. One is the investment principle, which find an asset that gives you maximum return, and the cost principle, the capital principle. You have to find the cheapest money, because if your return is greater than your cost, you're going to be creating more value, more wealth, more return. Another definition of the company's cost of capital is the opportunity cost of capital for the firm's existing assets. The minimum acceptable rate of return when the firm expands investing in average risk projects. In other words, if I'm thinking about investing in a new market or a new company or a new plant or a new product, how much is my cost of money today? Let's say it's 6%. Today, June 29th, 2020. But I'm now going to invest in a project in the future. I want to make at least 6% return on that future project, because that's my cost of money today. That's the stake in the ground theory. All right, it's costing me 6%. I need to make at least 10% off this new investment, and probably a lot more. That's what that means. Capital structure is the mix of long-term debt and equity financing, used to value new assets that have the same risk as the old one. Let's say I'm thinking about investing in a project in New Mexico and building a new plant there. The risk of that project is the same as all my other projects in my company, all the other asset investments. So I will use as a measuring stick the cost of capital. Now, don't let this theory drive you nuts, but it's fairly simple. The company's cost of capital is the weighted average of returns demanded by debt and equity investors. First of all, R of assets, that's my expected return, is taking the cost of the relationship of debt to the market value of the company. That percentage, this is the capital structure. Debt as a percent of the market value of the company times the cost of debt. plus the relationship of equity to the value of the company, that capital structure percent, times the cost of equity. You calculated this cost of equity last week in question number 4 on quiz number 1. We're going to learn about the cost of debt tonight and establishing that relationship. Now, a point of contention, okay? Total market value of the firm debt, V, is debt plus equity. Now, we can also use the book value as well, depending on the situation. But whatever it is, it's got to be debt plus equity equals the total. That relationship of that total could be total assets or the total market value of the company. Now, sometimes that total market value of the company is a difficult thing to have. So sometimes we just use the book value. But we'll talk more about that in later discussions. But it's the relationship of capital structure to the cost plus the relationship of capital structure to the cost. Cost of debt, cost of equity. This is defined in Chapter 9. So here's an example. Not Microsoft, but Macrosoft Incorporation has issued long-term bonds with a present value of $25 million and a yield of 8%. So they have to pay 8% on that money. It currently has 12 million shares outstanding, trading at $20 each, offering an expected return of 14%. What is the firm's cost of capital? So the present value of their debt is 25 million, and the present value of their equity is 12 million times 20 bucks. $20 for each stock trading at with 12 million shares. The yield on those bonds, or the cost of that debt, is 8% for the bonds and 14% for the equity. To calculate that 14%, we would use the capital asset pricing model, but that's already given to you in this problem. So debt is 25 million. Equity is 240 million. That's their market cap. 12 million shares times $20. So the total value of the company market-wise is $265 million today. You know, tomorrow it'll be totally different. Stock prices change every day. But as of this, their total value of the company is market value of debt, market value of stock, $265 million. I take that percent of assets, of debt to the total, times the cost of the debt, the percent of equity to total value at a cost of 14%. If I do the arithmetic, their WACC is 13.43%. 13.43%. So on average, the combination of the percentage of debt in the company at market value to its cost and the percentage of equity to market value at cost, meaning as of today, it's costing this company on average, based on the capital structure of this business at market, almost 13.5%. That's our cost of capital. That's our discount rate. That's our opportunity cost. Now, for proper value, how can I value the value of a company if I know that? Okay. I have to take into account its after-tax cash flows. Okay. So now I have to modify my weighted average, and look what I'm doing here. On the equity side, it's exactly the same. The relationship of equity market value to the total value times the cost of equity. But it's important to include tax in the cost of debt. Why? Because tax is deductible. The tax is deductible. So we have to take the debt of this company and multiply it times 1 minus the tax rate. So let's say my tax rate is 40% and my debt is 8%. 1 minus T is 60%. So my true cost, the after-tax cost of debt is not 8%, it's 40% 60% times 8%, or 4.8%. Let's take a look at that. So here we go. The WACC is calculated in 3 steps. Calculate the market value of each security, and in some cases, if we don't know that market value, we have to use the book value. Either or is fine. Determine the required return on each security. What is our cost of debt? What is our cost of equity? And calculate the weighted average of the after-tax return on the debt and the return on the equity. So for example, now we're given the same problem. Things have changed though. It's another day, all right? Let's say a firm has $30 million in outstanding debt with a required return or a cost of that debt of 8%. It has $8 million in equity at $15 a share with a required return of 12%, and their tax rate is 35%. So first of all, we know their debt position is 30 million. If we take 8 million shares times $15 a share, we get $120 million. So step 1 tells us the company has a market value of $150 million. Well, you can figure out the tax rate, Efren, if you know the amount of taxes paid in relationship to the profit of the company. You can back into the tax rate. But in our class, I will always give you the tax rate, so you don't have to worry about that. But you can calculate that a little bit. But for our class, I will always give you the corporate tax rate. So that's step 1. The company has a, now what? Oh, thanks. Okay, no worries. So now we have $150 million value. What's next? All right, the debt is 8%, the equity is 12% return, and the tax rate is 35%. All right, now we do our calculation. 30 million is our debt as a percent of 150 million. Our tax rate is 35%, so we subtract 1 minus 35%, meaning 0.65 times 8%, our after-tax cost of debt, 0.65 times 8%. We take the relationship of $120 million equity to the total value and multiply that by 12% to get 10.64%. I'm going to do that now in a spreadsheet so you can see that. Let's go back to our spreadsheet. Create a new slide here, a new tab. And we're going to determine WACC based on the problem we just saw. Let me make this right here. Follow along. Okay. So remember the formula in the equation, and here's our oops. So we got the relationship of 30 million over 150 million, which is our relationship of our debt. All right, and we're going to multiply that times 1 minus our tax rate, which is 35%, and that's going to be multiplied times our 8% cost of debt. So let's just do that little portion there. 30 as a percentage of 150, that's 20%, 20%, 25%, 20%, all right? 0.65 is our after tax, taking out tax, times 8%. 5.2%. There it is right there. So now if we take the relationship of the capital structure, 20%, 30 over 150, times the after-tax cost of debt, 5.2, we get a total weighted cost of debt to equal 0.2 times 0.0, or let's just say 5.2%. (1.04%). That's our weighted cost of debt. After tax, 65% of 0.8. Weighted of the debt position, 30 over 150. That equals 20% of 5.2, 1.04%. This is debt. Let's do equity. Okay, remember we're working on this problem here. So now we're going to do this equity portion right here. 120 million equity value as a percent of the total value, 150 times 12%. And we're going to add them together. So let's do that. So equity is 120 over 150 times 12%. That's simple. That's our return on the equity position. So if we do that, do the weight. So the weight of 120 over 150 is 80%, which makes sense because our debt position was 20%. And our return is 12% given to us in the problem. We didn't even have to calculate that. So our weighted cost of equity is equal to 80% times 12%, 9.6%. That's our weighted cost of equity. So our total WACC is equal to, you add the two together, equals 1.04 plus 9.6, 10.64% is our WACC, the combination of the two. We're going to be doing this a few times over the next few weeks. Some of them have some missing holes that you have to fill in, but that's what we're going after these next probably 5 weeks. No, I would say 6 weeks, the rest of the course. So taking a look at one last time at that PowerPoint, notice 10.64% is the WACC of this company, where we took the market values, the percentage of debt and equity of those market values, the cost of the debt less the taxes, because that's deductible, and the cost of equity arrived at by the capital asset pricing model, put all those together, and we get the calculation that we just did, 10.64%. So this is in your Blackboard. It's in week 4 in class review, so you have this template. But when we come back from break, we're also going to look at the third tab in this spreadsheet right here, where we're going to go through the problem in a little bit more specific terms, a little bit more details. So we'll take a look at that after our break. Okay, I'm a little bit late for the first hour, but let's take a little break for 10 minutes. I'll see you back here a little bit after 7:20 p.m. All right, we'll see you then. Darn it, Rick. So now that the video's going, and I missed the poll. Son of a... Wendy, your job is to make sure I turn on the video after break. I've done that twice now. Last week I really screwed up. So let's bring up the poll one more time, just so I can share it for our video. All right, so Wendy, you're in charge of that in the future. But here, since we started our video a little bit late for the second half of the class, I wanted to show this for the couple students who are not in class tonight so they can see this. We did a poll in class about the question, debt or equity financing, what is better? And here's our poll of our 18 students in our class this evening. 61% said equity for a good variety of reasons. Reasons meaning you don't have to pay it back right now. It's issuing performance of your company. You don't have to worry about too much about cash flow. And equity, and then the debt position, as some of us said, was 7 of our students, 39% said debt. It's cheaper, the cost is cheaper, you can deduct it on your taxes. The only downside of debt naturally is you have a payback period where you don't have that in equity. But also in equity, you lose control a little bit of your company, and that can be a determining factor. Okay, good. All right, I want you now, if you have this slide of week 4 in class review available, I want you to bring it up. If not, again, you have the video, we're going to be talking about this, but this is another example of determining the weighted average cost of capital, all right? And the weighted average cost of capital in this company is 9.29%, all right? And we're going to go through the process of determining this 9.29%, very similar to what we just did, but in this case, we're also going to determine the cost of equity, kind of like you did in quiz 4, the question number 4 in quiz number 1. So here we have a company that has a capital structure of the following, and it's given to you: 44% debt, 56% equity. So that totals 100%. If you ever have a capital structure that does not total 100%, something's wrong, okay? So the value position of this company says we have 44% in debt, 56% in equity. There's our capital structure, okay? We're going to determine the weighted average cost of capital by determining the cost of after-tax cost of debt and the cost of equity. Well, here's the cost of debt. Their interest on their debt is currently 10%, all right? Their tax rate is 40%. Again, you will be always given the tax rate. So if I wanted to determine the after-tax cost of debt of this company, it's the interest rate on the debt, sometimes called the current yield, times 1 minus the tax rate. Well, the tax rate is 40%, so 1 minus 40% is 60%. So 10% times 1 minus t, 60%, gives us 6%. Our after-tax, let's highlight that, our after-tax cost of debt, okay? And again, why we take out the tax is because, yes, we are paying our investors 10% on this debt, 10% interest payments, coupon payments, whatever. But on our corporate tax return, we can deduct that interest up to our tax rate of 40%. It's deductible. So the true cost of debt is taking out that tax deductibility, 6%. So down here, if I take 6% times my weighted average of 44%, remember I got 44% up here given. We just calculated the 6%. If I take 44% times 6%, I get a weighted after-tax cost of debt of 2.64%. Cool. What is our cost of equity? Now we're going to have to calculate this, just like you did in quiz number 1. The risk-free rate of this company with a beta of 0 is 1.75%. Not exactly the real world now. The market return of this market, of the economy that this company is in with a beta, an average of 1, is 8.5%. The company's beta, their actual risk in the market, is 1.50. Remember, beta is calculated by taking the standard deviation of the average return over the last 16 rolling quarters. That's 4 years. So the company's return has deviated to the average returns in the market, and it's determined that their deviation has been rather large, thus they have a high beta of 1.5. They've deviated from the average quite a bit. Let's not talk anything more about statistics involved in this because it'll make your hair curl. All right. So the cost of equity, remember the capital asset pricing model is taking the risk-free rate plus the market premium, and the market premium is defined as the market return minus the risk-free rate times the beta of the company. So doing my arithmetic, the risk-free rate is 1.75, the market return is 8.5 minus the risk-free rate, 1.75, and we multiply that difference or that premium times 1.5, the risk and the beta of the company. So 1.75 times 6.75 times 1.5, do the arithmetic, 11.88% is our cost of equity. We have 56% of our company is in debt per our capital structure. So we take 56% of 11.88%, 6.65%. Excuse me. We add the two together, after-tax weighted cost of debt, cost of equity weighted, our WACC is 9.29%. This would be our discount rate in looking at analysis of return on a potential investment. It's our discount rate. It's also called the hurdle rate. It's also the opportunity cost. It's also called the cost of cach. Cach meaning cash. Let's make that so you guys don't get confused if you look at this later. What the hell is Haskell talking about? Cash. Those are the different ways of determining, they go by. A lot of companies don't even call it WACC. They call it the hurdle rate. We got to make a return higher than 9.29% or we're going to get thrown out on our butts by the company. Our board members are not going to like that. Or our opportunity cost is 9.29. In other words, we got to do better than 9.29. Our cost of money, our cost of capital, our weighted average cost of capital. Different names, like you all have different names for me. Cool, honest, good looking. You have different names for me, so we have different names for our cost of capital. Smile, Peter, it's supposed to be a joke. All right, so we have different names for the cost of capital. There he goes. So 9.29%, all right? Now, it looks like a bunch of mumbo jumbo, but it's really pretty simple. And I'm sure you guys have done this before. I'm refreshing our memories for some of us because I know some of us hasn't taken finance in quite a while. So to practice this, this is what I want you to do this coming week. We go to Blackboard. If I can find it in all this mess. Hang on. There it is. All right, we go to Blackboard. There it is there. Okay, here's our Blackboard. By the way, tomorrow or by Thursday, when you get your quiz, case study number 1 grades, go to the report card and see your cumulative average in the class up through case number 1. That'll be a good thing to note for your reference and how you're doing. So if I go to class discussion forum, right here, you'll see discussion post number 3, weighted average coat of capital. Really, Mr. Hassey? Coat of capital? Very nice. Should be cost of capital. I'll change that. So what I want you to do this next week is as a follow-up to question 4 from case study number 1, I would like you to create a weighted average cost of capital for your selected Dow corporation, for your company. Wendy, turn on your mic. What company did you pick in question 4?
Procter & Gamble.
Okay, so Wendy will do Procter & Gamble. Joanna, what company did you pick for question 4 in case 1?
Disney.
Disney, okay. So Wendy has Procter & Gamble, Joanna has Disney, and all the rest of us, all right? In question 4, you've already calculated the cost of equity portion. You've already done that. That was your answer in question 4. You've already done the cost of equity, the capital asset pricing model. Your analysis, God, was I drunk when I did this? Your analysis now must determine the debt and equity capital structure percentages from March 31 balance sheet of your company. So Procter & Gamble, Disney, you find the March 31st financials and determine, you just go by the book values. Don't worry about market values for this one. Just go and find the balance sheet for Disney, Procter & Gamble, Home Depot, all the companies we have, and find the percent of debt to equity on that balance sheet. That'll be your capital structure percentages. Then, to determine your cost of debt, you're all going to do this. All right? Then everybody's going to have the same information for the cost of debt. I wanted to keep this fairly consistent. First of all, your corporate tax rate will be the current corporate tax rate, average tax rate in America right now, 21%. Right now, after the Trump administration changing the tax law, the average corporate tax rate, some pay more, some pay less, you're going to use 21%. The current 10-year average corporate debt yield now is 2.41%. So there's your cost of debt, the yield, 2.41%. Tax, interest, all right? You should be able to get that. Now for this announcement, we will have the same cost of debt. Your interpretation will be based on the capital structured percentages and the cost of equity for your particular Dow Index Corporation. So now you're going to put these numbers together. You're going to determine the percentages of debt and equity for your particular company as of March 31. It can't be December 31st because I'm going to be looking at the March 31 balance sheets of your companies. Your tax rate is 21%. Your debt rate is 2.41%. Your cost of equity, you've already calculated in question number 4. Determine the WACC. Put those all together to determine the WACC of Procter & Gamble, Disney, Home Depot, JP Morgan Chase, all of ones. Peter, what did you have? What was your company?
Tesla.
Tesla. Ooh, Tesla. All right, cool. All right, so use the Tesla. All right. So then after you do that analysis, just like you kind of did a couple weeks ago, I want you to only find one other student's weighted average cost of capital and compare it to yours. Compare it to yours. Meaning, how does it compare with your company? Similarities and differences related to the industry. You guys might be different because you might be doing two different things, right? Market, competition, risk. So I want you to pick another student's and compare your cost of capital to theirs and tell me why you think they're different or why they're similar. They might be in the same industry or whatever. You be the creative one. Create a forum, give me this information. It's due Sunday night at 9 p.m. Happy 4th of July weekend. Sorry. All right. The devil of going to school in the summertime. Sorry. But you can kick this out of the way this week. All right. Again, let me go through it one more time. You've already have the cost of equity from question number 4 in quiz. And God, why do I keep calling quiz? Case number 1. Then you find the capital structure of your business, your corporation on March 31st, the percentage of debt and equity. Then you determine the after-tax cost of debt by this information in points 1 and 2. Then you put them all together to determine the WACC and then compare it to one other student, just one. You don't have to do more, just only one. But I want you to give me some similarities or differences and the reason why you think that in your discussion post. Cool? Oh, we got questions already. What's going on here? No, that's from last week. Don't worry about it. Okay, so that's that. That's your graded work for this week. That's your graded work for this week. Any questions in this regard? If you do have questions, you can submit them to the discussion forum or ask me, but I think they're pretty straightforward. I'm giving you all the debt information. You have to look up the capital structure information, and you already have the equity information. Most of your real work is going to be involved in analyzing it to somebody else. You know, 2 or 3 paragraphs of your analysis to somebody else is fine. don't feel like you got to write 2 pages, just a few paragraphs that make sense in your analysis, okay? And if I feel you don't give me enough analysis, I will post you back to your discussion forum and say, maybe you might want to add a little bit more substance to this. I'll let you know about that as I read them during the week. It's due next Sunday, 9 o'clock. This work represents 5% of your course grade, 5%. So at the end of this work in this discussion forum, we will have completed 1/4 of the grade of our class, 25%, at the end of this discussion post. 1/4 after 4 weeks. Hey, Mr. Hassey, that's pretty good. 25% of your grade will be determined at the end of this work. All right? Cool. All right. Now let's do something else. But I'm kind of getting ahead of schedule now. This is pretty good. Oh, I got you all in front of me now. Everybody, this thumbs up. This all makes sense. This discussion forum, everything. Jessica? All right. Wendy? Oh, you got your thumbs up. Yeah, very cool. All right. Okay, Efren, thank you. Okay. Okay, Stephen, thank you. Joey, yes. Carrie, Tiffany, Elizabeth.
All good.
All right. Thanks, guys. Okay, that's good. Thank you very much. Oh, I got a lot of chats here. Everybody says good, good, good. Okay, good. All right, good. But that's going to be kind of yeah, I know this work in the discussion forum seems kind of mundane, but it's going to lead into case 2, 3, and 4, and your case paper, capital budgeting paper. This all is going to flow into it, and now you've practiced how the numbers come from and where they come from. You interpret them maybe a little bit in the discussion. It's all going to add to the strategic decision making we'll be doing as we move through our course. Okay, and that's why there's a method to this madness. All right. No, I'm not in the class yet, Peter. Hang on. Soon, though. I know you guys are, after 2 hours, you guys start saying, what the hell is he talking about now? Okay. Hang on, Peter. I got to show you something here. Where is it? Oh, there it is. Okay. Again, there's a lot of material in your weekly folders. Okay, there's a lot of material. Don't blow that off. Take a look at them. Some of the hints to casework and assignments and discussion boards are in this material here. Don't feel like, if he's talking about in class, why do I have to look at this? Take a look at some of this stuff. This is put there to give you little tidbits, little analysis, little information that will help you in this assignment this week or future assignments. So don't be afraid to look at that. Here's the PowerPoint that I went through in class tonight, and here's the spreadsheet file that we just did. All right, I will update this as soon as class is over, but that's what we'll do. Now, coming attractions, and then we're done. There's a method to this madness in this class, and here we go with this method here. Get you all guys all tuned in on the same page as I am, and then we'll be all right. Our theme in the first part of our class, okay, is just to refresh ourselves on a couple of key concepts of finance. And case 1 and 2 are both going over those concepts. Time value of money, capital financing, debt, equity, even profits. Statement analysis. What do our financials tell us about us? Does that make sense? Tells us about us, yeah? and about our industry and our place in the industry. All right? And now, as we now go into the next phase, what is our cost of capital cheaper the better. And how does all this information lead us to decision making? And that's the next phase of our course, decision making. Decision making in asset investment. Where do we put our money to get maximum return, maximum profit at the cheapest possible cost? Because sometimes the asset investment will raise the cost of the money. If I'm going to build a plant in Albuquerque, New Mexico, cool. But if I decide to build that plant in California, where there's more environmental issues, where the costs are higher for taxes and employees, where the disability and the government regulations are higher, that means the risk of that investment in California is going to be higher. That risk in California will make a higher cost of capital. Where the investment is and the nature of an investment is very important. If somebody came up to me today and said, "Hey, Rick, we have an opportunity to buy a business for your company, to diversify." Oh, what's the business? Weapons manufacturing. Really? You want me to buy a gun company? I think that goes a little bit against the culture of our company, willing to give back to the community, forging ahead with diversity, making sure everybody is giving back to society. When you want to buy a gun company? Well, it might be a great investment. It really might. Speaking of that, Remington Arms is for sale if anybody's interested. They just declared bankruptcy. But is that investment comes with a lot of risk. I don't think some of our employees are going to be too happy with us if we start investing in a weapon manufacturing company. I don't think some of our investors, maybe we have some colleges and universities investing in their portfolios in our stock, and I don't know if they'd be very happy if we're buying a company that makes bombs. There's other things involved in the decision, and that's what we have to think about. Not only the numbers, and as Raphael says, you want to find cheaper costs, but also there's other factors. Social responsibility, the climate of the economy, the climate of our investors, the climate of our employees. What's one of the biggest themes of the last 3 or 4 years in corporate management and governance? The Me Too movement, diversity in our employee base, and diversity in who we do business with, and making a profit, and then giving back to the community that we use for our employees and for our vendors, for the environmental issues we're doing in our community. What is one of the major 3 factors of corporate governance over the last 3 years? And you guys are going to be involved in this even more in the future. Sustainability, social issues, diversity, big deals, very big deals. And a lot of American companies are recognizing that now, especially because look what's happening to Facebook the last couple of days, if anyone's been following it. A lot of companies are dropping Facebook for their take on giving people a platform to say some of their ideas when some of their ideas are very offensive and I don't even want to see them. And Facebook is losing some partners. A lot of companies are losing some partners. And now you see a lot of companies jumping on the bandwagon. And this is where I get a little upset. Bank of America, oh yeah, we're going to start giving more money to minority businesses. I've heard that before too. Let's see how that works out over the next year. let's put them now to the task of, okay, you're going to lend more money to Hispanic and Black businesses and Indian businesses? Sure, great. All right, we'll check back with you in a year and see how you did. Then we'll see. And that's a big issue now. And this is issues of corporate finance that we need to be aware of. And it's around us now. So is the asset investment, yeah, Rick, is the asset investment risky or not? And that risk is applied to not only financial, but social, environmental, political, all right? All these issues, and you have to be aware of that. And one of the things I'm going to be having you do later on is have you look at a company, not financially, but what's this company doing socially? What do they say in their corporate financial information about what they're doing for society? This is a big deal now in corporate America. And it's long overdue. Long overdue. Me Too movement, diversity issues, equal pay for your gender. All these issues are very important. And these are things that are going to be added to our discussions going forward. And that's where I want to ask a lot of you of what are these issues at your company or issues in your area of your business? Is your company talking about these? Some of you might be in HR. You might be quite involved in this. I'm going to be passing on some information of what's going on at the University of Laverne now. University of Laverne is changing some of their investment management away from traditional investment and investing in social companies, diversified companies, environmental companies. Now, yes, they're taking a hit for that as far as return, but they're showing their community they care. And that's a big deal. So this is where we're headed in the decision-making process is, yeah, we got to decide on investing an asset, but yes, we have to worry about the time value of money. We have to worry about capital financing. We have to worry about financial statement analysis and where we stand. And we have to worry about what our cost of money is. But at the same time, there's a hell of a lot of other things we need to worry about as well. And that's going to play part of this. And this is where we are right now. And we're going into further details about this as we move forward in the class. So I'm going to save this and post it to our week 4, just so you have a little vision. And get rid of that, get rid of that. And it's the 8 o'clock hour and I'm done. All right, that puts a smile on Wendy's face. And so as usual, I will open this up and stick around for a few minutes if any of you have individual questions. But I think you'll enjoy, even though it's a little bit of numbery. But that class, the discussion forum this week of finding WACC and then relaying it and interpreting it to another student's calculation, that should be good. That's the beginning of our interactive decision making, looking at comparables, and that's where we're headed to in this class. Not only just the number crunching, but what does it mean? What does it tell us? So look over your case number 1 work as I post it back tomorrow. If any of you have any questions on that, you can bring it up to me in the Wednesday office hours or at any other time. Just ask me any questions or concerns about how I came up with some of that analysis. If it's bothering you, please do that now. Maybe I made a mistake. Maybe I could be convinced that I made a mistake. Whatever. All right, everybody. Thank you for a good evening. We're off and running with cost of capital, decision-making and investments, and beginning the 5th week. God, next week is our halfway point. Do you believe that? Time flies when you're having fun. All right, everybody. Have a good night. I'll post this lecture video tomorrow morning. Adios, everybody. Thanks. Good work. See you, Peter.
See you. Take care.
Okay, Peter, take care. Wendy, what's the background tonight? What is that?
It's a Lion King.
Oh, very nice. Very nice. Okay.
Actually, I wanted to stay on because I had a question.
Okay.
So, because I realized that I made a mistake in my calculations for the assignment one.
Okay.
And so I had a question because I got confused on for the car loan for number 2.
Yes.
And so for some reason, I guess I made it harder than it had to be for figuring out the periodic rate.
That was
Because
pretty easy.
I was looking in the textbook and I thought for some reason it was compounded, so I used the one that was the effective
Well,
rate.
remember, Wendy, this is not an investment, it's a debt,
Oh,
right?
okay.
This is borrowing for a car loan. So that's why the compounding is not part of this. If it was an investment, yes, you would be right on track. But remember, this is a debt payment that we have to make.
Okay, because that's what I was going to ask you. I was like, when do you use that one then? Because
That's the example. If it would be an
okay.
investment. If I said, oh, here's an investment of $22,000 compounded monthly, boom, there you go.
You know what's funny is I had done it the right way first, and then I was like, let me double check my work, and so I actually started reading the textbook, and that's what confused me.
Well, I wouldn't worry too much about it. If you just missed that, don't worry about it.
Okay. Well, I don't know. The other ones are yet to be determined because he only showed the first 2, but
Okay. Well, don't worry too much about it, Wendy.
okay, cool. Thank you.
Okay.
Because I was thinking about like, what did I do? Why did I was thinking, I was like, gosh, it was so simple. And then I used like that formula.
Don't worry, and we'll see how you do, and I'll post it tomorrow, okay?
Okay, cool. Well, thank you for answering that. That makes
All
sense
right.
now.
Bye, Wendy. Have a good week.
Bye, you
Oh,
too.
adios.